Recently retired as the Governor of the Reserve Bank of Australia. Paul Jenkins, Carol Wilkins, Timothy Lane, and Tiff Macklem are all current or former Deputy Governors of the Bank of Canada. It's quite a record. Reinforcing this proud tradition, the department will fill the new Jaroslawski Chair in Central Banking this year. So we're very excited to have this new position. Today's talk reflects this tradition. I would like to thank the Western Economic Society, who's right here, for inviting our speaker, Lawrence Schembri, the Deputy Governor of the Bank of Canada. Mr. Schembri has been affiliated with the Bank of Canada since 1997, serving as Deputy Governor since 2013. He oversees the bank's analysis of domestic economic developments and shares responsibility for setting monetary policy in Canada. He holds a Bachelor's of Commerce degree from the University of Toronto, a Master's in Economics from the LSE, and a PhD in Economics from MIT. His published research has focused on exchange rates and monetary policy in open economies, the international monetary system, and financial stability. He'll speak today on what's core about core inflation. He will also discuss the Bank of Canada's inflation update. We are pleased and excited that we have been selected to host this event. Please join me in welcoming Lawrence Schembri, Deputy Governor of the Bank of Canada.
Thank you, Bob. Thanks, Bob, for that very kind introduction. It's a great pleasure to be at Western today. It feels like I'm on home turf. As Bob mentioned, Western has put out a lot of impressive students in economics, and we have many of them here at the Bank of Canada. Indeed, 4 of my 6 colleagues in the bank's governing council are Western grads. So I've really benefited from their insights and from their education here at Western. So it's a pleasure to be here. And I especially want to thank the School of Social Sciences and the department for their new establishing a chair in central banking. I mean, I think that's a great step forward for the study of central banking in Canada. So I'm very pleased to hear that, because at the bank we very much welcome research on central banking, and Western has a very well-deserved reputation for high-quality research. And we very much look forward to collaborating with the new research chair. Now, just in October of 2016, the bank renewed its inflation control target agreement with the federal government. And this is the 6th time we've done this since 1991. And we renew the agreement every 5 years. Now, the inflation control target is a critical component of our monetary policy framework, which also includes a market-determined exchange rate. It allows us to have an independent monetary policy that is aimed for the benefit of Canadians. It's not often that a policy like the inflation control target performs better than expected, but this one did and continues to do so today. And so we'll look at that in a minute. Okay, so the 1991 agreement, the first one, set out a path for the progressive reduction of inflation, which was higher at the time, to 2% by 1995. And so the target has remained at 2% since then. So let's look at the impact of the inflation target on the economy. We can see in this chart that over the last 25 years, we have reduced and maintained CPI inflation at a level close to our 2% target, with no persistent deviations outside of our 1 to 3 control range. Indeed, inflation has averaged 1.9% over that entire period, very close to our 2% target. I think we're probably among the most successful central banks in achieving an inflation target. So because inflation has been low, stable, and predictable, Canadians have been able to make better economic decisions and achieve better economic outcomes. Real output over this period has averaged 2.5% per year, and there's been much lower volatility in things that are important to Canadians, in particular in inflation, in interest rates, and real GDP growth. So because of the success of the framework, the renewals have generally gone smoothly, but I want to assure you they're not automatic. we take the term of the agreement to conduct intensive research, to reflect on different aspects of the agreement, and we consult widely with academics, private sector economists, and also other policymakers. And for example, leading up to the 2016 renewal, we examined 3 questions. Is 1% the appropriate inflation target? How do we incorporate financial stability considerations into the formulation of monetary policy? And how should core inflation be used and measured? And so this third question is the focus of my talk today. So just to give you a sense of the outline of the rest of my presentation, I'll first review the purpose of core inflation measures in our policy deliberations. What role do they play in the conduct of monetary policy? And therefore, what do we look for in reliable measures of core inflation? Lastly, next I'll review the 3 new core measures we've adopted and what they are telling us about inflationary pressures. So let's start with the basics. Inflation is a general increase in the average price of goods and services over a given time period. We measure inflation using the increase in total CPI, which is estimated and published by the Stats Canada. Now, the CPI basket is representative of the average consumption of Canadian households in Canada. It is a broad gauge that is relevant to most Canadians. And this is important because inflation must be widely understood and visible for citizens to hold policymakers accountable. I mean, it needs to be a legitimate target in a democratic society, so it's important that we use a target like the CPI. So our monetary policy framework posits that CPI inflation will be at 2% on an ongoing basis when actual output equals potential output. Now, what is potential output? It's the level of goods and services that an economy can produce and sustain without adding to inflationary pressures. And so what I've done on this graph here, this chart here, is to plot potential output in red. So that's the level of output that the economy can sustainably produce without creating inflation pressures. And then the blue line is actual output growth, actual output. And so you can see that the deviations between the two are our measure of the output gap. And so you can see since the Great Recession of 2008, 2009, the output gap has been negative, below 0. So that represents the fact that there's been excess capacity in our economy over this period. Now, one of the key themes in my talk today is that the output gap or excess capacity in the economy and the labor market reflect are important determinants of inflationary pressures in our economy. Now, we achieve our target by using our policy interest rate to align the demand for domestically produced goods and services with the economy's capacity to produce those goods and services. But what we often observe, there are very sharp movements in total CPI inflation, that these sharp movements are often quickly reversed. Since monetary policy has long and variable lags, that's the well-known statement, on economic activity and the inflation rate, we need to look through that temporary volatility to achieve our inflation target over our policy horizon, which is roughly 2 years. So we need to basically forecast CPI inflation and also the output gap looking forward through these price changes. Now, if we reflexively raised our policy rate or whenever inflation was above target or lowered it whenever inflation was below target, we would end up reacting to a lot of temporary factors. And this would cause what economists call instrument instability, which is like when you're driving a car and you tend to overcorrect when there's a change in the road or a change in your driving, and that creates instability in your driving. And it's the same thing with inflation targeting. When I was taught to drive a car, I was told to steer high when I was driving the car, and that would help keep the car aligned in the lane. And this is exactly the same thing as inflation targeting in the sense that we have to look through the temporary variations and really look towards achieving the target. Now, for this reason of needing to look through temporary deviations, the Bank of Canada and many other central banks use core inflation measures because it helps filter out transitory deviations from CPI and therefore serves as a useful operational guide for policy. Now, measures of core inflation, they help us estimate where the underlying trend of inflation is relative to the current, to the target in the current quarter or current month or quarter. So that gives us a starting point for looking ahead to our projection of inflation. It also helps us corroborate other measures that we use to look at excess capacity and inflationary pressures. So given that use of core measures, what do we look for in an effective measure of core inflation? So essentially, there's three criteria or characteristics we look for in a reliable measure of core inflation. The first is that it's unbiased. It tracks CPI inflation over time. Secondly, as I mentioned, it should be less volatile than CPI inflation. In some sense, it should be more persistent. It should be subject to less volatility. Third, it should be related to the underlying drivers that theory would tell us should determine the underlying rate of inflation, and that is most notably excess capacity. And fourthly, it should be relatively easy to explain and understand. Now, let me describe how we typically measure core inflation. A common approach is to exclude items from the CPI basket based on certain criteria, such as volatility. This was the approach we took when developing our former measure of core inflation, which we called CPI-X. Now, we used CPI-X for a number of years, but then we came to the realization that CPI-X suffers from an inherent weakness. The fact is that what we exclude is only evident after the fact. So typically, we excluded a fixed set of items when we created CPI-X, but some of those items, some of the most volatile items, weren't in the group that we actually excluded. Now, for example, in the span of 12 months in the early 2000s, the inflation rate of automobile insurance rose from 2% to 30% over a 12-month period. At the peak, this component of the CPI basket was adding a full percentage point to CPI-X inflation. This example highlights the problem of excluding a fixed set of components ex ante. So, and adding more components to more items to a fixed list of exclusions based on their observed price volatility would not solve the problem of unexpected spikes in the future of other components. And so what we need is really a more flexible approach to estimating core inflation. And so what we did was to look for these flexible measures, and that led us to adopt three measures of core inflation that I'll talk about now. The first measure that we decided upon was we call CPI-trim, and it excludes the CPI components whose prices in a given month have exhibited the most extreme movement. So essentially, CPI-trim excludes those components in the top 20% and the bottom 20% of the price change distribution in a given month. CPI-median, the second one, captures the price change located at the 50th percentile of the distribution of price changes in a given month. And lastly, our third measure is CPI-common, and it uses a statistical approach known as common factors to capture similar broad-based movements in price changes across all categories in the CPI basket. We found these three measures, CPI-trim, CPI-median, and CPI-common, perform well across the set of evaluation criteria I just mentioned. In particular, they allow the data to speak and therefore more accurately identify persistent movements in inflation and therefore reflect the underlying, the evolution of macroeconomic variables important to monetary policy. Still, each of these measures is not perfect. This underscores the view that monetary policy should not be based on the mechanical use of such indicators. As policymakers, we grapple with a high degree of uncertainty in estimating trend inflation and the output gap. Using multiple measures like the three I just discussed helps us manage this uncertainty about the different measures of underlying inflationary pressures. Now let's turn to and look at the reliability of these measures. So on this chart, I've plotted total CPI inflation, which is our target, in red, and then the range of our preferred measures, the three measures I just mentioned, are in blue. And you can see that all three measures were extremely effective in seeing through temporary movements in CPI inflation. Now, of the three, CPI-common was the top performer for two criteria. It was less likely to be influenced by temporary factors, and it moved most closely with the output gap, which is theoretically an important determinant of the underlying rate of inflation. Two of the measures, CPI-median and CPI-common, fell short on one criteria. They're relatively more difficult to explain and understand than CPI-X. But I hope this speech and the supporting documentation on our website will help in this regard. Now, all three measures that we selected performed better than CPI-X, our former measure, for three reasons. So this is again, this is the range of measures in blue that we've selected, and CPI-X is the black line. And you can see that they are less influenced by sector-specific shocks and therefore more accurate measures of underlying inflation. And this can be most clearly seen in the episodes that I've circled in the chart. So the first circle represents the sharp rise in auto prices that I mentioned earlier. There was also a significant movement in auto prices, which actually declined just before the Great Recession. And then more recently, we've had a run up in meat prices. So you can see that CPI-X has been heavily influenced by these sector-specific shocks, whereas the measures that we have adopted see through these shocks because they're more flexible than CPI-X. Now, no measure of core inflation can filter out every type of temporary shock. And an important one for Canada, because we are an open economy, is the fact that exchange rate movements can have a profound impact on consumer prices, as we saw last year with vegetable prices. So exchange rate movements can have a persistent level of prices through import prices and also through their effect on the price of domestic import competing goods. But this level effect is typically transitory for the rate of inflation. So that this exchange rate pass-through effect, which we call ERPT, does not necessarily warrant policy action or policy response as long as inflation expectations remain well anchored at 2%. A second important advantage of these measures, the new core measures, is they better capture persistent movements in inflation. You can see this in the chart too, that the range is much less volatile than for CPI-X. So we see persistent movements in trend in inflation. And so that is another important advantage of these measures over CPI-X, which statistically measured shows absolutely no persistence. So these measures are significantly more persistent than CPI-X. And third, the three measures have much stronger relationships with key macroeconomic drivers, such as the output gap. So looking at the correlation between these three new measures in the output gap, the correlation is roughly 0.5 or 0.6, whereas the correlation of CPI-X with the output gap is only 0.2 over the sample period since 1991. So again, it's consistent with a theory that would help you explain the underlying rate of inflation. Now, all three measures, as well as CPI-X, are unbiased estimates of total inflation. So they generally track total inflation well over time. So if you look at their averages since 1991, they're essentially the same as total CPI inflation. The big difference is obviously the volatility. Now, the fact that they are unbiased estimates mean that if you're generating outlooks for all three measures of core inflation and CPI-X, they would tend to converge to CPI over our projection horizon because the transitory factors that we're trying to look through would typically drop out or dissipate. So let's take a closer look at the behavior of these three measures. So here, instead of a range, I've actually plotted each measure individually. CPI-trim is in red, CPI-median in blue, and CPI-common in green. And you can see that these three measures have generally evolved broadly in line over time, although there are instances where their behavior has differed. For example, most recently in the fourth quarter of 2016, the range of these measures has been relatively wide, more than 0.5%. Now, to explore the behavior of these core measures, we've used an analytical framework that, based on the well-known Phillips curve, which some of you may have seen in your classes. We assume that core inflation depends on the excess capacity in the economy and the degree of exchange rate pass-through. So we've added the exchange rate pass-through because it's important in Canada. Because we're an open economy, we do see exchange rate effects on core inflation. And in the short run, inflation is also affected by relative price changes and other temporary demand and supply shocks. So the new core measures are constructed to minimize these temporary disturbances and relative price shocks, so they should, in principle, largely reflect movements in excess capacity. So let's try to decompose the sources of their movement. So here I've got CPI-common on the screen, and what we've done here is tried to decompose the sources of the movements in CPI-common. And essentially we've looked at three sources: excess capacity, or the output gap, shown in yellow, exchange rate pass-through, shown in green, and an unexplained residual term, which represents these temporary factors that show no persistence over time, or not a lot of persistence over time. So the charts for the other two measures are shown in the text of my speech, and so they show a similar pattern. Now let me say a few words about each of these elements. First, the excess capacity, which is the blue bars. This has had a material and a persistently negative effect on these three measures of core inflation, as I explained, since the Great Recession. So you can see the blue bars since the Great Recession of 2008, 2009 have been predominantly on the negative side, exercising downward pressure on the different measures of core inflation, in this case CPI-common. Whereas exchange rate pass-through, as you know, the exchange rate's depreciated since mid-2014, driven in large part by weaker commodity prices, and so that depreciation of the Canadian dollar has had upward pressure on CPI-common here. And the third factor is clearly that we can't, with this framework, we can't explain all the movements in these core measures, so those are the yellow bars. So there's still some work to be done in terms of analyzing the other factors that are influencing these core measures. So let me quickly summarize our analysis of the behaviors. So just going back to the chart that I put up earlier, these three measures have declined since mid-2016, close to 2% or just below, in part because of the diminishing effects of exchange rate pass-through and the effects of excess capacity that have persisted in recent years. Now, the divergence among them may reflect, in some sense, the prevalence of negative shocks that have hit the economy and persistent, and the fact that excess capacity has persisted. So because over the most recent period, we've had a persistence of negative price shocks to inflation, because the shocks are asymmetric, that can have different effects on the different measures. Now, in addition, let me say as policymakers that we view the divergence of these measures not necessarily as a weakness, but an important insight that validates our decision to use all three measures. If we had focused just on one measure, we would have been led astray in our assessment of the underlying trend of inflation. So having three measures actually gives us a better sense of where the underlying rate of inflation might be. So it's now time for me to conclude with some key messages. Now, a key challenge we face as policymakers is to distinguish the trend from the transitory inflation. That's why measuring core inflation is core to our approach in formulating monetary policy. The better we are at separating the two sources of inflation, the better we are at understanding the current state of the economy and underlying capacity pressures, and the better we will be at achieving our inflation target. Our ability to achieve the inflation target is the means by which the bank and the target earn credibility and trust. That credibility gives Canadians confidence and helps anchor inflation expectations. And this creates a virtuous circle. Having expectations solidly anchored at 2% is critically important for the conduct of effective monetary policy and achieving the target, especially in turbulent times like the recent Great Recession, which allowed us to reduce our policy rate and at the same time reduce real interest rates and stimulate the economy because inflation was well anchored at 2%. So please allow me to switch to French for a moment. Malgré notre succès dans l'attente de la cible depuis 25 ans, nous faisons tous, sauf nous reposer sur nos lauriers. Il est important pour nous de tirer des leçons de l'expérience et des travaux de recherche universitaire, afin d'améliorer sans cesse notre cadre de conduite de la politique monétaire. Pendant la période qui a précédé le renouvellement de la cible l'an dernier, nous avons mis à jour ce cadre en remplaçant l'IPCX par 3 nouvelles mesures de l'inflation fondamentale. Ceci nous permet une appréciation plus efficace de la tendance sous-jacente de l'inflation. Le recours à plusieurs mesures nous aidera aussi à gérer le risque associé aux lacunes de l'un ou l'autre de ces indicateurs. Nous allons mieux communiquer l'incertitude liée à l'évaluation de l'inflation. As I said in French, although we've had 25 years of success hitting our target, we are anything but complacent. We're committed to learning from experience and from academic research, including work conducted here at Western, to continuously improve our monetary policy framework. We used the period leading up to the last renewal of our target last year to update the framework by replacing CPIX with 3 new measures of core inflation, which give us a much more effective reading of the underlying trend of inflation. Using these multiple measures will also help us manage the measurement risk associated with any single indicator and to better communicate the uncertainty involved in gauging inflationary pressures. In our past monetary policy reports, we have provided projections of CPI-X inflation and regularly described the extent to which these movements were due to sector-specific shocks. However, we've come to realize that this attention paid to CPI-X may have created a misperception that it was the target for monetary policy rather than merely a useful operational guide. Going forward, we've decided that only the projection for total CPI inflation will be included in the monetary policy report. In addition, we will focus on our analysis on the key forces underpinning the inflationary process. Now, these new core inflation measures will contribute valuably to this analysis. In that regard, I want to emphasize that these measures are only one set of inputs into our broad and ongoing assessment of pressures on capacity and inflation in the Canadian economy. We also take into account a wide range of information, including responses to our Business Outlook survey and more informal conversations with businesses and other Canadians. For many of you in this room, hearing about life in Canada before our inflation target, when inflation and interest rates were in the double digits, must be as difficult to imagine as life without laptops and smartphones. However, for those of you who are old enough to remember when mortgage rates hit 19%, firsthand know how transformative the past 25 years of successful inflation targeting has been for family finances and for our economy more broadly. At the bank, we understand that Canadians want and expect low, stable, and predictable inflation, and we are committed to meeting those expectations through the successful conduct of monetary policy. Thank you for your attention. I'd be happy to answer any questions you may have.
My pleasure as the chair of the Department of Economics to thank Deputy Governor Mr. Schembri today for being with us. As Dean Anderson said, it's quite fitting, I think, for us to have a talk today on inflation targeting and how the bank is modifying and refining the measures that it's going to use to implement that policy. In the 1980s, there were several prominent key economists who were here at Western at that time who were doing research on exactly the issue of high inflation and what to do about it, and they provided a lot of evidence and policy advice to the bank to adopt inflation targeting as their measure. It's great to see how successful that has been and how the bank, and to learn how the bank is, again, looking at how to continue to do that better for all of Canadians. So I think Peter's going to handle questions from the audience, and I can help as well. So we'll let Peter take it over.
Do we have any questions from the audience?
Yes, I just wanted to ask you something I think might be, students might be wondering about. And so in order to guide monetary policy, you need to predict core inflation out over a period of 2 years, I think you said. And so I was wondering if you could say a few words about how you form those predictions.
Okay. Thanks for the question. I think what's important to remember is that we use core inflation to give us a sense of where the economy is at the moment, that essentially what the starting point for our projection is. So we get a sense of where the underlying rate of inflation is relative to target, and we look at other measures of capacity pressures, in particular our estimates of the output gap, as well as other measures. So that gives us a starting point for our projection. And then going forward, we actually project total CPI inflation because that is our target. So we're definitely, that's the focus. And we use two different models that we have at the Bank of Canada. One is a dynamic stochastic general equilibrium model called Totem, and another one is a more empirical model that we call Lens. And we use the two models to basically generate those estimates by. Those models entail the evolution of forces determining aggregate demand over time. And those models are obviously fed in by variables that come from the rest of the world. We have an international department that provides us estimates or forecasts of commodity prices and forecasts of the U.S. economy and other economies important to Canadian exports. And those are fed into our models. And out of those models, we get we project the evolution of aggregate demand and the output gap, and that allows us to forecast total CPI inflation. And based on those projections, we make a decision on the interest rate. Should we adjust the interest rate to affect aggregate demand in order to influence the timing of the closing the output gap and then the evolution of CPI inflation?
Hi, I just had a kind of a basic question. Do you find that a lot of political decisions in Ottawa will affect the data that you receive in terms of shocks or negative shocks?
Well, we tend to, our policy with respect to announcements from the government is when the announcement is made, whether it's at the federal level or the provincial level, in terms of certain policies, whether they be fiscal expenditures or changes in tax rules or something like that. Once they're announced, we actually incorporate them into our projection. So it does play an important role. For example, the fiscal expenditure plan that was announced by the federal government in March of last year, we've incorporated that into our projection for 2017 and 2018. So those policy changes that affect overall aggregate demand within the Canadian economy will be incorporated into our projection and affect the course of monetary policy because it affects our outlook for inflation.
Hello. The graph where you had the three effects, you had the exchange rate effect, the output gap, and then you had the residuals.
Right.
I noticed that the residual effects after the Great Recession seem to have been larger in magnitude than they were prior, and they, after a short period, remained negative.
Mm-hmm.
Could you guys, can you explain kind of what the bank thinks is going on there? Thank you.
Well, that's a very good question. I think this is a subject of ongoing analysis, but I'll try to offer a bit of an explanation that we think is reasonable. That I think what's happened since, especially since mid-2014, when we had a significant decline in commodity prices, we've had a lot of ongoing adjustment in the Canadian economy, and so we've had large impacts on relative prices over this period of time as the economies had to adjust to this shock. And part of that is clearly exchange rate moved, depreciated to facilitate that shock. And while we try to capture all the effects of the exchange rate on domestic prices, whether it be import prices or domestically import competing goods, it's an imperfect estimate. So I think when you get a lot of adjustment taking place in the economy, there are going to be factors affecting relative prices that is very difficult to explain using a very simple model. And so I think this is part of the problem. What we're seeing is that when there's a lot of adjustment, relative prices have to change, and sometimes that's hard to pick up in a very simple model. So, but as I mentioned, this is subject of ongoing work.
Any other additional questions?
Yes, so I have heard that there is a bit of debate among academics and in the public regarding the level of the target, what would be appropriate. So there is an argument that 2% is too low because in events like a Great Recession, its central bank cannot effectively respond and stimulate the economy. What are your thoughts about that?
Well, as I mentioned, that was one of the questions that we looked at in our most recent renewal of the inflation target. We looked at the question of whether the target should be raised. And what we came down to is essentially it's a trade-off between the fact that it's like an insurance policy. The sense that is, if you raise the inflation target, you're essentially imposing a cost on the economy that's going to persist for a long period of time. And that's kind of like a premium or something you would have to pay in the event you need to use monetary policy if there was a severe shock that pushed you down to what we call the effective lower bound, because we can only reduce interest rates to zero and possibly somewhat to a negative level, but there is limits on how far we can go. So policy becomes less effective the further down you go. And there are other measures like large asset purchases, but they also have potential unintended consequences for the financial system. So there are these risks of hitting the effective lower bound, but we felt that there are other means to sort of prevent those things from happening. Like, for example, making the financial system more resilient is one way of preventing the type of crisis we had in 2008, 2009, which was caused by a widespread financial crisis. So it didn't seem worthwhile for us to impose a cost that was ongoing by raising the target to remedy a situation where monetary policy would have to be dealing with a situation in which interest rates were very low for a prolonged period of time. So it was that we looked at that trade-off, and we looked at a number of academic research, and it just seemed like the costs of having an inflation rate higher than 2%, especially since most other central banks around the world have chosen 2% as that target, just didn't seem like it outweighed the benefits of being able to reduce the policy interest rates further when you get closer to zero.
Great, so we've got time for about 2 more questions. So we've got one right over here.
I'm just curious, when it comes to decisions to raise or lower interest rates at the central bank, is it often that there's a lot of consensus one way or the other, or is it debated quite heavily in all the meetings?
Well, within the Bank of Canada, we have a process by which the staff prepares a projection of the Canadian economy and prepares a projection of the Canadian inflation rate, and then makes a recommendation about what the governing council should decide upon in terms of the interest rate decision. And then once that staff projection is made, the governing council discusses it, and we come to a consensus on what the decision should be. And so there is, some discussion amongst ourselves, but there is a process where we filter a lot of the information. We look at the projections the staff produces. And so given that we're seeing a lot of the same information, it's relatively straightforward to come to consensus.
You mentioned a couple times the costs associated with raising the target.
Yes.
Could you explain why? Could you explain why there is a cost associated with raising the target?
Well, higher inflation generally means that it gets more difficult. Typically, what you see with higher inflation is you get more variable inflation, and you also it gets more difficult. As you know, when an economy is allocating resources, what matters for the allocation of resources is relative price movements. And so when you have higher inflation, the signal from relative price movements gets confused. And so you get a poor allocation of resources. And so that's why having very stable, low and predictable inflation really creates an environment where firms and households can make decisions effectively, because they're going to make decisions about allocating resources based on relative prices. And if they know the inflation rate's stable and they see a price move, then demand and supply can adjust. Whereas the higher the rate of inflation, it gets more difficult to identify relative price changes, which are important to allocate resources.
Great. And this will be our final question. Do we have a...
Thank you. I saw the slides that the GDP gap has been increasing since 2015. Is that means the economy is still under pressure of deflation? So that means the bank should set an aggressive inflation code to solve the deflation problem.
Well, one has to be careful. Inflation is just simply below our target. If the output gap is below our if there's a negative output gap, what that would imply is that there's disinflationary pressures, which means that inflation is below our 2% target. And so what we've set is an interest rate that we feel is sufficiently stimulative to get us back to our inflation target, to close the output gap, and to get us back to our inflation target by middle of 2018. So we do look at the output gap, we do look at the impact it has on inflation, and then we adjust our interest rate accordingly to basically adjust the level of aggregate demand to close the output gap and therefore reach the inflation target. So when we're in a situation where there is an output gap, where there is excess capacity, we want to stimulate the economy, and generally, as you know, interest rates have been relatively low for a long period of time to provide the monetary stimulus to support aggregate demand.
Great. Well, thank you very much. Thank you, Deputy Governor Schembri. We really appreciate the opportunity to have you do the presentation at Western today. That ends our formal proceedings for today, and I'd like to thank all of you for coming out. At this point, I would like to actually ask the Western Economic Society if we can get Mitchell and Carol to come forward. They'd just like to present a token to the Deputy Governor.